This week was all about the Federal Reserve, inflation, as well as some shifting expectations for where rates are going to go next. And the biggest headline actually came later in the week yesterday. President Trump did announce yesterday on social media that Kevin Warsh will be the next Fed chair, and he'll take over that in May. Just saying, if you go back to previous weeks, that was what we predicted. And, markets didn't necessarily love the news at first because Warsh is seen as less friendly to rate cuts than some of the other names that were discussed. But he is still dovish and will be a big change from Powell. For now, it hasn't really helped mortgage rates. But that said, Warsh also has said publicly that the Fed should have been cutting rates sooner. And some analysts believe he's more willing to look past the lagging inflation numbers that we've talked about, as well as focus on where inflation's actually headed. We've talked about real-time numbers and true that are already at the Fed's made-up 2% target. And he's also served on the Fed before and has been pretty openly critical about how monetary policies led to inflation getting out of control in the first place. So while markets didn't really respond too well immediately, it isn't necessarily bad news for rates in the longer term. On the Fed itself, the central bank did hold rates steady this week, which was expected. Two members did actually want to cut, and Chair Powell did acknowledge that job numbers might not fully reflect what's happening in the labor market again. And the Fed is still very focused on getting inflation back to its target, even though Powell admitted that housing inflation is clearly cooling and that higher prices in some areas are being pushed up by temporary factors like things like tariffs. And that brings us to inflation itself. Wholesale inflation for December came in hotter than expected, especially on the services side, and that was not great news. But it is important to note, again, that real-time housing numbers continue to show rents falling, vacancy rates are rising, and housing inflation is running much lower than what official reports are showing still. And that lag is a big reason that markets believe inflation is going to continue to cool. And productivity also jumped, which does help with wage pressured inflation and keeps it in check. And it also supports lower inflation over time. And on the labor side, jobless claims moved lower again, but that doesn't necessarily mean the job market's strong. A lot of people are leaving traditional unemployment because benefits just don't cover their bills, so then they're turning to gig work or temporary jobs like Uber. And this is still a low hiring, low firing economy, and it's definitely not booming. I'd hate to be looking for a job right now. And on that same note, consumer confidence dropped, hitting its weakest level in more than a decade. Fewer people feel jobs are plentiful, and more people think jobs are hard to get. And that kind of sentiment, usually leads consumers to pull back on spending as well. And one more housing headline worth noting, in case you missed it, the administration did approve a much higher limit for Fannie Mae and Freddie Mac to buy mortgage bonds. And that does support demand in the mortgage bond market and helps put, downward pressure on rates, even if they don't use the full amount. But looking ahead, next week's a big one. We're going to get multiple labor reports, more inflation numbers, and a clear sense of how markets are kind of digesting this Fed chair announcement. But that's it for this week. I'll see you next Friday with another update on what's moving mortgage rates.